Good morning. This is Larry McMillan with a market update on Monday, May 18th before the market opens. Well, we backed off the top of the trading range last week at 29.50, and we backed off pretty quickly. In just a couple of days, we're all the way down to breaking the 2800 support briefly intraday and bottoming out around 27.65 and then rallying again. And then last night, Chairman Powell was on 60 Minutes, said a lot of bullish things, and the market is expected to open sharply higher this morning, and we've practically regained all of those losses. So we moved from the top of the trading range to perhaps what's a newer support level in 2 days, and then back up again in 2 days. This is pretty fast action, and it doesn't look like it's going to end anytime soon, although um, volatility, implied volatility is still decreasing slightly. We'll get to that in a minute. So I'm still looking at the S&P chart as being in a trading range, and even if it does break out on the upside, there is a resistance at around 3,000 where the 200-day moving average is. If it were to go back down, there's support at 27.20 and then stronger support at 26.50. The equity-only put-call ratios remain on buy signals. They're down low on their charts, which means they're in overbought territory. But still, they're on buy signals and they don't look like they're rolling over to sell signals anytime soon. Breadth, however, has been pretty wishy-washy, and right now, at the current time, the two oscillators are split, one on a buy, one on a sell. But I think the thing to take away from breadth is that it really hasn't been all that great, and usually there's a penalty to pay for that somewhere down the road. New lows have edged ahead of new highs on a couple of days last week, and actually on 3 consecutive days in terms of stocks only data. But that's not a terribly negative indicator yet. What we are looking at, though, is if there were to be more than 100 new lows than new highs on the New York Stock Exchange data, that would be negative. Um, as I mentioned, volatility has fallen. We have another, actually the third in a sequence here of VIX spike peak buy signals. So that's a short-term positive in that regard. Longer-term VIX still remains above its rising 200-day moving average, so that's a longer-term negative. And as long as that's the case, there's still downside potential in this market. As I mentioned before, that sort of condition existed in 2008 and 2009, and we did go back down again. It didn't really dissipate until March 2009, which was the actual bottom. The term structure of the fixed futures and the CBOE volatility indices has improved greatly, and it's right on the verge of turning bullish, but it hasn't quite made it yet. So to summarize, it still looks like we're in a trading range with a possible negative bias here just because of the VIX being above its 200-day moving average and S&P being below its 200-day moving average. So we're retaining a core bearish position while trading short-term long positions around that. I invite you to visit our website. We just had a great seminar on Saturday talking about advanced spreading techniques that is available for purchase, as well as several other things, including a new trading indicator that we're offering on tradingview.com.